So Prime Minister Liz Don't Trust and her Chancellor Kamikaze Kwarteng have dropped their mini budget and it's gone down like a lead balloon.
That is a disgrace.
So with interest rates spiralling, the pound plunging and recession looming, what does this all mean for property investors? What are the opportunities for property investors? Stay tuned to find out. If you're new to this channel, make sure you subscribe and hit the bell icon. We put out new pieces of content each and every week, so you don't want to miss out. Also smash that like button. We've got a lot to unpick in this video. There's an awful lot that's gone on in just a week. Now, quite frankly, the media is quite confusing because there's a whole lot of vested interests among the newspaper barons and also the media channels. So you really have to dig down to source information to figure out what exactly is going on. And more importantly, what it means for us as property investors. Now, before we get started, I want to tell you a little bit about the Baker Street Property Meet. It's the UK's largest property investors networking event. We meet on the last Wednesday of every month in central London at 6 p.m. Now, details are all on the website bakerstreetpropertymeet.com. It's a place where 300 property investors meet up each month. Join us because each month we focus on specifically topics like this and how you as property investors can turn them around to your advantage. So join us at our always full events, bakerstreetpropertymeet.com, last Wednesday of every month. Now, quite frankly, what's going on is a little bit of a shitstorm. It doesn't look as though the left hand knows what the right hand is doing. And I think that's fundamentally what's affected market confidence in UK PLC. Now, what do I mean by that? Well, last week, of course, we had an interest rate decision where the Bank of England put up interest rates by 0.5%. I put out this video to cover exactly what was going on by that decision. But literally 2 days later, the Chancellor Kamikaze Kwarteng put out his mini budget. And it was quite apparent that the Bank of England, in setting the interest rate policy, and the Chancellor in setting his mini budget, did not communicate. There was no joined up thinking, if you like, in how these two policies actually work together. In other words, the market, I believe, lost confidence that there was an overarching plan for the economy going forward. And confidence is everything. So the Chancellor Kamikaze Kwarteng drops his mini budget. What's in it sounds great. It's a whole bunch of measures to deal with the energy crisis, mainly capping of electricity and all of that sort of stuff. But the thing is, these measures are going to cost £100 billion, and that money is funded by just adding it on to the national debt. Now, quite frankly, I think this is a bit of a perverse way of dealing with the energy crisis. We generate energy in the UK from all sorts of sources. Only 5% of our energy actually comes from Russia. But we have a very strange electricity market in the UK where the cost per unit of electricity is dictated by the most expensive source of that electricity, regardless of the actual input cost. So what I mean is the market prices electricity per kilowatt unit or whatever, regardless of whether it comes from wind power, nuclear or gas or wherever. If you think about it, those wind farms in the North Sea or those nuclear power plants, their costs of producing electricity haven't doubled or trebled. So quite frankly, it's a little bit of an aside. I would rather they dealt with this energy crisis by tackling a rather strange energy market that we have in the UK, which basically means that people pay a distorted amount per unit of electricity they consume. Bills haven't risen by anything like as much in places like France and Germany, and yet they are far more exposed to Russian gas. So if £100 billion wasn't enough added on to the national debt, Kwarteng also came up with a whole bunch of tax cuts. Now, quite frankly, all the principles behind all these tax cuts are perfectly sound and make sense. And in normal times would stimulate growth, there's no doubt about it. We have a lot of strange incentives or lack of incentives in the tax system, which actually penalise people, particularly middle-class earners. And I believe Kwarteng was trying to tackle this. The reforms on stamp duty were absolutely great, where you can now buy a house up to £250,000 without actually paying any stamp duty. Now, that's just for homeowners, by the way, not for property investors. Now, stamp duty, of course, is a very strange and unfair tax. When you buy a home, you have to fund the stamp duty out of cash. You can't borrow it. And do remember, stamp duty was only brought in as a temporary tax to fund the Napoleonic Wars. Now, a lot is said that Liz and Kwasi are just trying to emulate successful budgets of Margaret Thatcher back in the 80s with this sort of tax-cutting agenda. The key difference there is Margaret Thatcher funded similar tax-cutting policies from economic growth, not by just adding it on to the government debt. And in those times, government debt was virtually non-existent. Quite frankly, it does seem as though we've got a bit of fantasy politics. By the way, if you're liking this video, make sure you like and let me know what you think about what I'm saying in the comments below. It seems as though the government's looking to have their cake and eat it. On the one hand, they want small government with less regulation, less red tape and less taxes. But what they also want is big government spending, where basically they're support programs for absolutely everything because they're vote winners. You simply can't have both in any economic climate. And if you try to do that during inflationary times, then you have got problems on steroids. In a nutshell, we already have high inflation. Then you want to add more government spending and more unfunded tax cuts, which is all going to be funded by leaping on more borrowing, which is basically creating more money out of thin air, which simply adds to the inflation. It really is like having a fire and then shoving petrol on it and hoping you're going to put it out. So this is really, really obvious. So why are the government doing all of this? Well, here I can only speculate, but Truss doesn't have long. She's only got a couple of years before she has to call a general election. And after what's been happening in the last couple of years with Brexit, COVID and all of that, she hasn't got long to turn it around. My personal theory is that the Tories know that the housing market is very, very important to Conservative votes. Homeowners tend to be Tory voters, therefore a feel-good factor in the housing market is absolutely key. And I think this is one of the thought motivations that was behind the stamp duty cuts. Because of course, if you cut stamp duty or eradicate stamp duty completely for first-time buyers, it means that the bottom rung of the housing ladder, the housing chain, actually gets moving and everyone gets moving up, and that's all good for the housing market. Where the government's gone massively wrong is thinking that they can just implement policy for the UK without considering what's happening worldwide, and especially without considering what's happening in the US of A. So what is happening in the USA? Well, in the USA and pretty much worldwide, we've been in a very low interest rate environment. And the Federal Reserve has also been printing a lot of money and doing quite a bit of government borrowing. So basically, when everyone else is doing the same sort of thing, then all the currencies kind of inflate relative to each other and you can kind of get away with it. And that's pretty much what's happened over these last few years. But the US is calling time on all of this now. Since the beginning of this year, they've decided to curtail their money printing activities because they really want to get a grip of inflation. So what they've been doing in the US is raising interest rates. And they've been doing so far more aggressively than the UK, the Eurozone and other leading economies. Why is that important? Because if I'm an investor and I want to earn some interest on some debt, quite frankly, if America are seen to be really focused and serious about capping inflation, plus they're offering a higher interest rate, then why wouldn't I invest in their debt as opposed to another country who doesn't seem to have a plan for inflation and is offering less interest, less return on my money? That's why there's been so much interest in buying American debt, and also the dollar has pretty much surged against every currency. What we have done in the UK has diverged from the direction of travel of everyone else. The US has gone down the route of tightening monetary policy, and the UK has gone along and loosened it. And the fact is, the UK currency and economy isn't big enough to diverge so much from the US. And that's why the pound has fallen so much, because people would rather invest in dollars. And to make the pound more attractive, we don't have any choice but to raise interest rates. If we don't, then quite frankly, we're on the track to currency dilution, more inflation, and ending up like Zimbabwe. Now, when the US puts up interest rates, it really is a different ballgame over there, especially in terms of how it affects ordinary folk. When the US increases their interest rates, it doesn't affect mortgage holders or domestic homeowners in the same way as it does in the UK. And that's because in the US, 30-year fixed rate mortgages are commonplace. If you've got your mortgage fixed for 30 years, you're not really bothered if the Fed decides to increase interest rates. And I think that's a pretty neat thing that they've done in the US, because the US currency is pretty much a global reserve currency. It's used for all sorts of things apart from people buying their shopping in Walmart. So they've kind of got to do this to kind of de-link the internationalized use of the dollar from the domestic use of the dollar for things like people's mortgages on their own homes. In the UK, we don't have that culture or that system of long-term fixed rate mortgages. People fix at the very best for 2 to 3 years at a time, or sometimes for 5 years, but the number of fixed rate mortgages are relatively low. So that means if the UK is forced to raise interest rates, it affects people, and it affects a lot of people with their domestic mortgages. So therefore in the UK, although they know that the interest rate medicine is necessary right now, they've delayed putting it into effect simply because it will affect homeowners far more, especially the people that have bought in recent times and who are highly indebted at very high loan to values. The choice the UK government has to make is a pretty stark choice. It's protect the housing market or protect the pound. It's impossible to do both without growth in the economy, and that's the one thing we don't have right now. All this is very interesting because this stuff is real. It's not about politicians coming on TV and giving clever, evasive, smart-ass answers in Sky News interviews and all of that, which quite frankly we're all sick to death of. This is a judgment made by the market. The market just doesn't have confidence in what the UK is proposing right now. They don't believe that we're serious on tackling inflation. The market is slightly jittery on how we are going to pay back all this debt, and they're also jittery on the amount of debt that we're adding each and every month. Each and every month, tax receipts are coming into the government, but more is being spent than is being earned in taxes. And against that backdrop, there's further taxes. It just doesn't make sense. So what the markets are saying is twofold. One, you are printing more money because to fund all this extra government borrowing. So therefore, if you've got more money in existence, the value of your pound has to become less. You're not producing any more through economic growth. So the value of your currency is going to be less relative to other currencies. And the second thing they're saying is that, well, if we are going to lend you money to fund all this stuff, then we believe that we should be getting a higher return on that money. Firstly, to compensate for this increased risk. And secondly, if Britain ain't offering that return for investors' money, then they'll simply go along and invest it in the dollar because they're offering a greater return. So that's basically the verdict of the world. So all this means, of course, the cost of borrowing money for the government to fund all this expenditure is going up quite a lot. What all this means, of course, is the cost for the government to fund all this government expenditure is going up. The interest rates that they're having to pay is going up. Up till now, it's been relatively low. I mean, you only get these sort of reports in papers outside of the UK. The Wall Street Journal has reported that 5-year bonds now, Britain is having to pay a higher interest rate on 5-year bonds than the governments of Italy and Greece. What that means, of course, is that the government has to service even greater interest payments on the debt, and that, of course, adds to the debt itself. So what does all this mean for property investors? Now, I put out this video on interest rates when the interest rate decision was made last week. It's had more than 24,000 views. And in that video, I predicted that interest rates will go up to about 4.5% next year. Well, that video is quite frankly out of date because 2 days later, of course, the mini budget was released. As I mentioned before, there was no coordination between the Bank of England and the Treasury team in coming up with these two policies. And the mini budget has kind of upset confidence to a level that the market is demanding a greater increase in interest rates than otherwise possibly would be the case. This lack of sync between the Treasury and the Bank of England has spooked everyone. Yesterday, we saw some massive news on a scale that I haven't seen really. The FT reported that 9 UK mortgage lenders literally pulled out of the mortgage market. They paused mortgage lending because basically the situation is so fluid. And what I really mean by fluid, there's a lack of direction. There's a lack of someone at the helm, if you like, controlling all of this according to some master plan, that the lenders felt they just need to put a cap and a pause on mortgage lending. So what the Bank of England need to do is to demonstrate that they have got a grip on this, they've got a grip on the inflation situation, and they're serious about tackling the inflation rate that we've got now. And that will need a pretty punchy interest rate rise. The next scheduled interest rate rise is 3rd of November. But there's a lot of speculation that the Bank of England could intervene with an emergency rate rise before then. And that could be 0.5% or 1%. But I would certainly expect to see base rates around 5.5% by mid next year. So let me give you my take on this and how all of this news will affect us as property investors. Generally, there's a lot of doom and gloom out there reported in the newspapers and on TV channels and all of that. There seems to be a lot of vested interest in seeing this government fail. And I have to admit, they're not doing a very good job of trying to demonstrate that they've got a plan and they know what they're doing. And I think what they've done in the last week or so is just a complete misadventure. But the fundamentals of the UK are still pretty good. At the end of the day, when the UK government does borrow money, it borrows in its own currency. Countries that are really in trouble are the ones that can't raise money in their own currency and have to borrow it in US dollars. But we don't have that problem in the UK. Essentially, what the government and the Bank of England need to do is to demonstrate that they have a clear plan for the next few years, a clear plan for bringing inflation down and starting to reduce the huge national debt. Now, to provide that sort of confidence, we are going to see a recession. There is absolutely no doubt about that. In the residential property market, we will see repossessions again for the first time in many years. The people that will be most affected by repossessions will be the people who basically got into the housing market last and who are highly indebted. So people who have borrowed to the max and then they've got all the other bills and all of that to pay and all of that, they will lose their homes. Now, this is basically one of those things that happens in every recession. It's a game of musical chairs. When the music stops, the last person left who hasn't quite got a seat, they get in for the chop. There's no sugarcoating that. That's what happens. And this will, of course, affect first-time buyer confidence. It doesn't matter about stamp duty and all of that. It will affect confidence in the housing market. And there will be a small fall in prices. I don't see it being a crash. The UK has a massive undersupply of housing. And that will provide a very natural floor at quite a high level to UK asset prices. Commercial property, of course, is a different ballgame. Commercial property is affected far more in recessions and will fall more than residential properties. But we have permitted development rights which allow people to repurpose these properties to residential use and therefore uplift the value quite significantly. There'll be a lot of people doing those sort of projects. Now, what I advise people to do is follow some of the money on this. What are wealthy individuals and companies actually doing? Bill Gates in the US is buying farmland like it's going out of fashion. James Dyson is also buying farmland in the UK. Lloyds Bank aims to be one of the biggest landlords in the UK of residential properties. All of these people are investing in income-producing assets. Recessions always produce opportunities like this, where income-producing assets can be picked up, financed and held until the next recovery and boom phase where those asset prices will rise again. The big losers from this recession will be, as I mentioned, the people who are highly indebted, who bought their houses relatively recently, and also the middle class professionals on salaried PAYE jobs who will end up paying the bulk of the cost of this extra government borrowing. The way to get ahead of all of this is, as I've mentioned, focus on acquiring income-producing assets. I suggest you attend one of my free taster sessions where I take you through exactly this strategy and how it can work for you during these times. So tell me what you think about what I've been saying in the comments below. Smash that like button, also subscribe and hit the bell icon if you're not already a subscriber. See you guys in the next video. High streets across the land are changing forever. Basically, there's an oversupply of retail premises. Shops are closing down, more are going to close down in the future. The government know this, and that's why they're introducing a light touch planning system which allows small developers to easily repurpose these buildings to residential use under a light touch planning regime called permitted development. Now, this is going to be the biggest revolution and the biggest change and the biggest opportunity for property investors that I've ever seen. And this is all coming into effect on 1st of August. So you need to know what's happening and what properties to look for to take advantage of these opportunities so that you can get in there and take that first mover advantage. I've got a 90-minute free masterclass to get you ready for August the 1st. Make sure you join me, click the link below. Whether you're a beginner or expert, we'll get you started.